My name is Jason Sen. I've been a trader for 35 years. You will know that already if you've been following my YouTube channel for a while. I started when I was 19 years old on the London International Financial Futures Exchange. I was lucky enough to be a market maker in the option pits, and I did that for 15 years or so. I moved onto the screens and was able to make that work. So I've got a lot of experience. Around 18 years ago, I started studying technical analysis. I even launched a business providing technical analysis and signals to banks and brokers, and now for retail traders. I'll be making videos running through the techniques that I use: moving averages, trend lines, Fibonacci levels, candle formations. Today, I'm going to cover moving averages. We're going to break down a chart and look for signals that can get you into a low risk position. It's very simple. Here we go. Now, the moving averages that I use are 50, 100, 200, 500. I use those periods on 4 different time frames. I usually study the 1 hour, 4 hour, daily, weekly, monthly charts. I don't go shorter term than that because the signals that I provide to my subscribers are valid for 24 hours. So if I start going into 15-minute charts, those levels are not going to be relevant for long enough. Now, I also use those moving averages because they work across the 25 different markets that I analyze to try and find decent low risk trades for my subscribers. This is a very recent chart of the E-mini Dow Jones. When markets are trending, the moving averages will eventually start moving in the same direction to indicate that we do have a trend. That's one of the useful aspects of moving averages. A 50-period moving average would be the first to indicate that we have a trend. And indeed, it did that here when the market started moving down very swiftly. Okay, then the market starts to stabilize. It starts to consolidate, which is a very common aspect of all financial markets. They all have a big move and eventually they will consolidate and they will trade sideways. This is when our moving averages are utterly useless. Well, not utterly useless because the 200 moving average did work as a resistance level there. So there's 3 ways that moving averages work. You look for price crossing over the moving average to give you a signal. You look for the moving averages to cross over each other to confirm a signal or generate a new signal. But I also use moving averages as support and resistance lines. So they are really very useful. There are 4 clear uses because they also help me to identify a trend. So I don't think that you can look at a chart without a moving average, but the longer the consolidation goes on, the less they'll work. And I'll show you why in a minute. Now, we start to get a clue that we could be starting a trend when the moving averages start to converge and then turn. Here, the 50 days already crossed over the 100. Now, that is not a signal to buy. The fact that the 50s crossed over the 100 there, to me, is not a buy signal because the 100-day moving average is still turning lower than the 50 days turning up. So they're both going in opposite directions. And in fact, the 200-period moving average was just moving sideways. So these are just a mess. I would not have taken a signal. Now, here, the 50 comes down, kisses the blue 100 and starts to move up. Price has been crossing above and below, which is quite normal in the consolidation. Very confusing. You don't know, of course, that it's a consolidation at first. So at first, when it starts crossing up, you're probably getting quite bullish here. So this is where you might lose on 2 or 3 trades before you think, okay, hang on, I'm losing on this. This is a consolidation phase. I need to wait and see how this plays out. You would then maybe switch to trend lines and wait for a breakout here, something like this. That might give you a pattern. Now, if you did that, you'd have some clues here. When we break above the trend line, we come back to retest it. The market is trading above the 50 and the 100 moving average. It comes back to test them. Now, you don't know if it's going to hold because you don't know if it's going to remain in a consolidation, but it tests the trend line, the 100 and the 50 period moving average. Then it starts to take off. If you're lucky, you'll get into a long position. You could, of course, have a pretty tight stop, so it would be worth the risk versus the reward. But there are 3 reasons why you would want to be getting into a long position here. I'm just going to put a trend line on here as well. The market's broken above the trend line. We tried to break above the 200, couldn't sustain it. We're testing the trend line and the moving averages. If you decided to get into a long position here, and their reasons are good enough, then, of course, you're feeling pretty happy as the market jumps. Now, a trailing stop strategy could run your stop just below the 50-day moving average. If you'd have done that here, of course, it would have kept you into a long position all the way up to here. You really would have had a good run from 31,150 to, let's say, what's the low of this candle? 33,500. You could have stayed in there for more than 2,000 points, you would have missed getting out of the peak there at 34,250. But that would have been a great trade with a trailing stop just below the black 50 moving average. We've got the 50 crossing above the 200, the 100 crossing above the 200. We've already got the 50 now moving away from the 100 period moving average to indicate that we've got an acceleration and a trend developing. Now, if at this point you weren't long, you've got all the signs here that we have a potential bull trend starting, and you could have got in. We didn't quite touch the 50-day moving average, but if you got in slightly aggressively just above the 50-day moving average, then you would have looked pretty good holding that long position if you had a stop in just below the 50-day moving average. I'm just going to see if the fib levels would have worked at this stage. Assuming that we're here in this point in time and you have identified the fact that we could be beginning a bull trend, you're a bit frustrated because you're thinking this is going to be a bull trend and I'm going to miss it. So you put your fib levels on here. I've got a 23.6% fib here at 31,614. I've got the 50 moving average. I think we're in a bull trend. That would have been an opportunity for you to buy into a long position. Admittedly, you'd have had to have gotten a little bit early, but only about 50 points early, which is nothing in an index which is trading around 31,500 for the Dow Jones. So let's say, for argument's sake, you did jump in here. You took advantage of the support level of the fib and the day moving average. Now, the market then collapsed. Would we have been able to get into a short position on this move down? Let's have a look if the moving averages would have helped. Price breaks down below the 50. We're stopped out of the long position. The price continues to go down. I may have tried to buy at the 100 if there was also a trend line and a fib level there. I'm not going to examine to see whether there was, but I would have been stopped out. Then the market bounces back and we test the 100. We actually get to the 50, can't hold it, and we close below the 100. That's your early warning sign. The trend's reversed. We're trading below the 50 and the 100. I'm now going to get into a short position. Obviously worked really well. The market did trend down. Again, you could have a stop just above the 50 period moving average. If you sold into a short position at the 100 period moving average, that would not have been great. You would have been stopped, but the 200 did catch it. So you may have lost here, but you may have got into a fantastic short position here. Can't help myself, but just test whether that was a Fibonacci level. It was a 50% fib level as well. So that may have given you some extra reason to want to sell into a short position there. And the market turns down. Now, beautiful. If you did get into a short position there, the market collapsed straight through the 100. You didn't even have time to cover it. You may have had a take profit order at the 50, to be fair. But if you didn't, the market then collapsed and broke down. Once we were below the moving averages, the price stayed below the moving average. You can see how the moving averages have given us a clear indication that the trend changed, the market is going down, and the moving averages are working as resistance levels because the price can't move above them. Here we enter a bit of a consolidation phase, which would have probably resulted in one or two losing trades as we got confused. Now, again, the moving averages turn. The 50-day moving average crosses above the 100. Now, the 100 is starting to turn, so I would take more notice of that. The 50 is already turning. We've got a potential bullish crossover. The price has crossed above both of them if you got into a long position here because prices crossed above the 50 and the 100. If you had a trailing stop just below the 50 here, you still would have taken advantage of a really nice move. This would have confused me. I would have been stopped out of a long position. Okay, I hope that's given you some idea, something to practice on how to spot when a trend changes. I did tell you that I would explain to you when moving averages do not work at all. They completely go out the window. And this is in a sideways consolidation. Now, this has been horribly messy for the Dow Jones. The moving averages are crossing above and below each other. The price is crossing above and below. They're not working as support and resistance levels at all. So you've got to be quite quick to identify when the market is probably entering into a consolidation phase and just disregard the moving averages and move to more of a trend line trading strategy to give you scalping levels. Okay, I hope that's helpful. If you've got comments, I'll respond as quickly as possible or some questions that you need answering.